Hi everyone, and welcome back to Financial Basics, where we make money grow with you. Today I want to be talking about the topic that is tariffs. It's all in the news, it's pretty much everywhere at the moment. Everybody is talking about it. And let's just get started. Sorry, I'm also drinking coffee. So this is the formula that you've probably seen in the news. It's how they calculated how much other countries are unfairly trading with the United States. The only thing to note here is this formula, the way this was derived and calculated, is it did not include any services. So any services in terms of selling those services across two other countries was not included in these calculations. And then there was also no foreign direct investment, so no FDI, that was also included. So if the other country that America is trading with is making enormous investments into the United States, or the other way around, then that wasn't taken into consideration. So really what this formula is a goods-only trade deficit for each country as a percentage of imports. I don't want to go too much into detail in terms of the actual formula. And what I'm going to do instead is I'm going to link below to two channels that both did in-depth videos on this and some of the implications of it. What I want to focus on in this video is mostly the impact on households. So the impact on the average household is going to be around $2,100 in extra spending. And even for the lower end on the income distribution levels, you're looking at an extra cost of $980. So what that means is, in general, across the income distribution for the lower end, they are going to have $980 less on an annual basis. What I want to be clear about here is this is absolutely a regressive tax. And what I mean by that is the poor end up paying a larger portion of it as a percentage of their income. So another good example of a regressive tax is actually a speeding fine if that fine is fixed. So if you speed and the fine is $100 might mean a lot more to somebody that's poor because of the percentage of their income versus somebody that's maybe earning millions every year. Then that isn't really going to impact their budgets. So we can clearly see through the analysis, and I've linked it below as well, that it impacts the poor more. There is also something called the TCJA, which is basically Tax Cuts and Jobs Act, which actually reduced taxes for companies and for individuals. So that obviously actually improved the situation. This analysis specifically looked at the combined impacts of all of these. So you can see that the tariffs more than make up for any gains that were made through the tax reductions. Looking at it from quintile perspectives, looking at it from 20% brackets, and this is earning brackets, the top 1% has actually gained in this situation. They're actually, across all of it, earning more, whilst the lowest 20% is actually losing 3.67% of their income. And the reason for that is just the impact, right? So looking at it as a percentage of their income, it's actually a bigger portion. The other thing to note here is it just comes down to choice. So the more money you have, the more choice you have, which ultimately means you are paying a tax because you have no choice. So if you are buying the cheapest pair of boots available because you're in that lower 20% and the boots cost $30, if tomorrow those boots cost $40, you're still buying those boots because the next cheapest boots might be $50. Whilst if you're better off or more middle class, then potentially you can choose to buy the $50 boots, or you were buying the $50 boots to begin with, and then this had no impact on you. So I just want to go through an analysis from the perspective of who are the winners in this situation and who are the losers. So for the winners generally with regards to tariffs are the domestic industries that are currently uncompetitive in the world markets. And a good example of that is actually Korean car manufacturers. So what Korea did was they had tariffs in place that sort of ring-fenced Korea. So any cars going into that country, they would put a massive tariff on. And what it allowed the local car manufacturers to do was it allowed them to almost, to some extent, exploit the local population, the car buyers, their consumers, where they could charge exorbitant fees for their cars, but then they would take the profit from those sales and sell their cars on an international level really cheaply. And that allowed them to experiment with what is a good car and what is a bad car on the international market. And they would be able to effectively cross-subsidize their local sales with their international sales to get better at international sales. It was okay for them to fail in that situation where they were cross-subsidizing. And then after a while, it's not necessary anymore, and we end up with companies like Hyundai and Kia that are South Korean car manufacturers that are actually really good today at producing well-priced cars and be competitive on the international market. Workers in those industries are also obviously going to benefit. The government benefits, and the reason why the government benefits is because it doesn't matter which way you cut this, doesn't matter who you think is going to be responsible and who you think is going to pay. Ultimately, this is a transfer of wealth from consumers in that country to the government of that country. And you can argue this might be a good thing, because if the government spends that money wisely on things like reducing deficit or buying local goods and services, then it could actually be good overall for the country and for the consumers. But in general, that transfer of wealth puts the government as a beneficiary of this, and the consumer as in the short catching that and actually paying that bill ultimately. The losers in this situation, at least from my perspective, the foreign exporters. So if you're exporting into the country, obviously you're gonna suffer. You're gonna have to pay more. And the reason for that is you might have a machine or a factory that produces 1,000 cars every day. And if you're doing that, you have to sell those 1,000 cars. Even if you're willing to, even if you're selling those cars at a potential loss, you've made the investment into the equipment. It's very difficult to roll that back and go, okay, I'll just deal with the lower volumes. Domestic consumers obviously suffer, as I've mentioned before. That money is flowing from their pocket to the government's pocket. Everything is going to ultimately be more expensive in that situation. The other guys that are going to suffer as well, domestic industries, but domestic industries specifically that are selling in the international market, they could actually see low demand. And then domestic exporters as well, they're potentially also dealing with retaliation. So that combination potentially hurts domestic industries. And then the other thing to mention that I haven't seen spoken about too much is just the middlemen. And what I mean by middlemen is anybody in that supply chain that potentially even is on the other side of the tariffs, that is looking at their margins, looking at the volumes, and they're only interested in maximizing the profit. So they're going to do quite a few things in their power to try and maximize their income. And if you have a 10% margin, you have a good coming in, it's for $100. You have a 10% margin, you sell that on to the consumer, so it gets to the door of the consumer, it's $110. If it came in and there was a 10% tariff, you're now paying $110 for that good. but you still want to maintain a 10% margin, you now have to put the price up by you have to add an extra $11 to your margin to maintain the 10%, because the price you're paying now with the tariff is $110. So they're going to do quite a few things, obviously, to manipulate that price that could hurt the consumer even more than the baseline. Oh, this is the tariff, therefore the end result, your product is going to increase by that price. It's also worth noting the extra revenue, depending on the sources that you look at. If the tariffs across the board were increased by 10%, the expected revenue is going to be in the 190 billion range, and if it's 20% tariffs, then you're probably looking at around 300 billion revenue generated. So the deficit at the moment is 1.83 trillion, which means you're not going to drastically reduce that deficit by even charging 20% tariffs on literally everything going into the United States. The other thing I wanted to mention, and just going back to that middlemen, those middlemen, it's a complete wash, and that's why I put them in that mixed category. Good example of that was in 2018, the Trump administration actually imposed a tariff on washing machines. It was a 10% tariff, and that actually led to a 11 or 12% increase in the price of washing machines. But what it also showed was that dryers, on an equivalent level, increased as well by 11 or 12%, by a similar amount, just because the suppliers of those products understand consumers see those two things as equivalent. They understand that consumers expect to pay a similar amount for those two products, so they can actually, even though there's no tariff, they can actually increase the price of the dryer, just because you're expecting that match, and they understand that consumers are okay with buying that. If there's a big discrepancy between the price of the washing machine and the price of the dryer, you might, as a consumer, go, there might be something wrong with that dryer. But this is actually what happened, and that actually cost, they estimate that costed consumers an extra $1.5 billion every year. Obviously, Donald Trump is outright saying interest rates are down, oil prices are down, food prices are down. Inflation is a myth at the moment. It's just not there. There is no inflation at the moment. And unfortunately for good old Donald, the math disagrees with you. So this is Matt Parker. He did a bit of an analysis. The average global tariff is, if these things are implemented, is 41%. Based on the math produced by the United States government, by the Trump administration, the pass-through ratio to consumers would be 25% of that. And based on that alone, the inflation would be 10.25%. And there's a whole bunch of analysis out there looking at specific different products and how much each product is going to be impacted. From what I can tell, most of the impact is going to be around things like clothing, leather products, upholstery. Like, it's going to disproportionately affect those things, but across the board it's going to affect a whole range of different products. So the question for me was, can you actually bring back manufacturing jobs to the United States? At the moment, there's about 12.7 million jobs in the United States that are manufacturing jobs. But if you look at jobs overall across the whole of the United States, it's around 170 million, 160 million. So the manufacturing sector is actually a really small portion of the overall jobs. And a lot of those jobs are not actually paid well. So these are jobs that most Americans don't actually want. Americans are very focused around services. In fact, they're actually a net exporter of services. So they don't carry a deficit, if that's what you want to call it, with regards to services, which is why I think the Trump administration focused just on goods. So can you bring back the manufacturing jobs? Well, the unemployment rate at the moment in the United States is only 4.2%, which means that even if you were able to snap your fingers and bring back all of these jobs and bring back a whole portion of manufacturing, there isn't actually the people there to actually do the work. Why was there a 90-day pause? I think it's just worth noting as well on this. This is a more recent development, happened a couple of days ago now. The 90-day pause was, according to Trump at least, based around the US government bonds, and I just wanted to look at that and do the calculation on that. The interest rate for the bonds was floating around 4.25%. The tariffs were announced, it dipped a bit, and then it spiked. And it spiked all the way up to 4.5%. At the moment, with $1.83 trillion as an annual deficit, if that was to be funded at 4.25% or 4.5%, that would carry an extra $4.575 billion per year in interest alone that would be charged on that extra interest rate adjustment. So there could be some panic there that with interest rates spiking in that way, especially if that trend was to continue, the government could be concerned about being able to sell through bonds at a reasonable interest rate. And what's actually going on here, if you want to just understand the bond market, the government or any government puts bonds out at a specific interest rate. So let's say they need an extra 100 billion and they put that on the market. Let's use this as an example at 4.25%. If they only manage to sell 50 billion of that, what they're going to do to get the other 50 billion sold is they're going to have to raise interest rates and then see if anybody takes at 4.3 or 4.4, and then they're going to continuously increase interest rates until people start buying again. So my thoughts on this whole situation. There's a ton of unknowns at the moment. And it seems the ground is constantly moving below our feet. I don't actually know what to do here. I'm not an expert on this, and I'm certainly I don't have a crystal ball where I can point you in the right direction and say, what should you do? What I will say is, I am not selling my investments at the moment. I'm not panicking. I'm not holding a bunch of extra cash. In the sense that I'm selling my investments to build that cash up. I'm not buying investments. I wouldn't normally consider. So I've seen a bunch of posts at the moment online and conversations going on online talking about buying single stocks and buying gold and buying crypto. I'm not doing any of that. I'm just doing my normal regular investments. As per normal, when the market dips like this, you have to just buy through. I'm not lumping a bunch of money into the market, although I was really tempted to, just on the basis that when the S&P 500 dipped below the 12-year average, or what it was 12 months ago, then I looked at that and I thought, okay, this is definitely an opportunity to buy. So I was thinking about moving into a more stock ratio in terms of my overall net worth, my overall portfolio. So should I carry more investments at the moment, more shares or more S&P 500? And I decided against it because I was like, I would rather hold onto a little bit more cash right now than do that. I am making sure my emergency fund is fully topped up and it's ready to go. And the other thing that I am doing is I'm just rethinking some of the bigger purchases that I might have considered, like a car, house upgrades or changes to the house, fixing up the house, whatever, new computers, new cars, all of these things. Until things have sort of settled down, I'm not going to be making any large purchases. I'm just going to, if I can hold off on them, I'm going to. Final thoughts. Ultimately, tariffs are paid by the consumer, no matter which way you cut it. It's the same as all taxes. A corporate tax is ultimately paid by the consumer. And it's the same with income tax, it's the same with sales tax. Everything is ultimately paid by the end user. So this is definitely a tax on everybody in the United States. For now, this is mostly, at least in my opinion, a reallocation of resources from the US citizens to the US government. We can debate whether that'll be good overall or bad overall, but that is actually on the ground what, in my opinion, is happening. So this is definitely a tax from that perspective. And we are yet to see the final results of this. There is likely to be reciprocal tariffs incoming. And my suspicion, based on the conversations that I've seen, there could be situations where China obviously targets goods, but the EU might be a little bit smarter and actually start targeting services coming out of the United States. Again, back to my advice, be strategic about what you buy and when you buy. And the impact, as per the example with the washing machine and the dryer, the impact could extend beyond the items specifically being targeted. It was a targeted tariff at a washing machine and you ended up paying more for dryers. And then I'm going to link them below. Just a shout out to PerunAU and Stand Up Maths, who looked at the actual formula where those numbers came from. And they were giving specific examples in their videos. It's a great videos if you want to dig deeper into it. If you like this content, please subscribe and share. I'm relatively new to YouTube. It would be great to get your support. And if you have any questions or requests, please feel free to email me at financialbasicsabc@gmail.com. Thanks for listening. Goodbye.